Good afternoon, everyone, and welcome to the StockTraders.net special webinar for presenting to you our software, which is called Pair Trade Finder Pro. And this is a webinar called Trade Pairs Like a Pro with Pair Trade Finder Pro. First off, I'm forced by legal reasons to read you a quick disclaimer. Trading involves risk. Only trade with capital you can afford to lose. Past performance is not indicative of future performance, and we are not regulated financial advisors. Everything we've got in this presentation, please consider it illustrative and for educational purposes only, and not financial advice. If you're going to start trading, but most of you already are, but if you're going to start trading anything new, a new strategy or a new size of account, then we recommend you talk to a regulated financial advisor before allocating that capital. By watching this presentation, you agree to hold us, Event Driven Investor Limited, the publisher of Pair Trade Finder Pro, free from any responsibility for losses that you may incur as a result of your trading actions. Okay, with that out of the way, let's move on to why we are here. Well, I've got a quote here from a recent empirical study of pair trading, and it's a study based on, we'll read through here. We examine a pairs trading strategy based on publicly traded common equities, so stocks. In stocks pairs trading, the trader takes long position for underperforming stock and a short position for the overperforming stock. The trader then profits from the correction of the divergence. And they test that on stocks that have historically a strong return correlation, and to determine the pairs. They find that the trading strategy that bets on this convergence generates alphas of up to 36% annually for an equal weighted portfolio. Very importantly, they do that using what they call a self-financing portfolio, so what we would call 2-to-1 leverage, which is in fact maybe a little bit less than 2-to-1 leverage. So 36% annually over a 40-year period. So who are we? We are Pair Trade Finder, and we've created a software. It's called Pair Trade Finder Pro, and it's one of the world's leading pair trading software platforms for equities, ETFs, and a bunch of other stuff. So we did it 10 years, well, we didn't do it 10 years ago. It was created by a guy named Jared Mann, and we being my partner and I, business partner and I, bought this 2.5 years ago from Jared. And the platform has been used by thousands of successful pair traders, both professional and retail. We have guys running, tens of millions of dollars with this software. And it's designed to allow any investor or trader to learn to make winning long-short trades consistently with controlled and measured risk. What can we do for you, and why do you want to watch this webinar? Well, first off, we're convinced that with our software, we're in a position to get you from where you are now as a trader or investor to generating consistent trading profits in less than 30 days. And by that, based on historic research, we're talking about 20, 30, or even 40% per annum. And very importantly, we think you can execute this strategy because we do it on less than an hour a day, and sometimes a lot less than that. So very quickly, there's a lot of information in this presentation. We don't have a lot of time for it, so I'm going to skip through a lot of this stuff quite quickly. But you'll have access to this slide deck and a recording of the webinar, so you can go through it at your leisure. My name's Geoff Stewart-Hosey. I'm the co-founder, owner, and managing director of Event Driven Investor. We own Pair Trade Finder. I've had over 20 years of experience in M&A, corporate finance, private equity, investment management, and trading. Just very quickly, I did my business school in Canada, was recruited from there, became a financial analyst at Solomon Brothers in New York when John Goodfriend was running the place. And I worked in the FIG group doing M&A. And from there, I went on to work for a private equity family office in Europe, where I was for about 7 years, ended up as a partner. Then I went on to become a partner at the Monitor Group, which is Michael Porter's strategy consulting, M&A, and private equity fund, and I worked there for about 4 or 5 years. After that, I started a hedge fund with Paul, who's my business partner and event-driven investor, and we ran a fund called Claridge Special Situations Fund in London, which was regulated and very professionally audited and had an administrator and all of that. The performance track record of that fund is in Annex A of this presentation. I then went on to do oil and gas investment in Africa, and I've done a lot of it. So that's who I am. Let's move on to Paul. Paul is he's the co-founder and owner of Event Driven Investor. We started it together for the acquisition of Pair Trade Finder. Paul is a TMT M&A guru, and he's been doing M&A in telecoms, media, and technology for almost 35 years now, I think. And he's also been doing VC, private equity, and public markets investing in those types of opportunities as well. He started off, he's an American, he did his MBA at Columbia. He worked at GE Capital in their LBO and restructuring group in New York. He then went to London, worked for Arkwright Capital, which is a group of ex-Bain and Company partners. And then he started a firm called Arc Associates, which was one of the first and most successful specialized technology, media, and telecoms boutiques in London. He's done tons of M&A. He's raised over 500 million of equity, and very importantly, he used to run the ARC investment program over a 7-year period, and he generated a 50% IRR in that program. And also, as we touched on earlier, we started Claridge Capital together, and that track record is in the annex. So what we're covering today, we're going to cover what is pair trading, quickly the history of how it started, why it matters to you as a trader. We'll look at whether it's still profitable. We'll talk about PTF PRO, our secret weapon, and then we'll take you through a special STOCKTRADERS.net offer that Monaco Trader has put together for you guys. So what is pair trading? Pair trading is also referred to as spread trading, stat arb, relative value arbitrage, or just long-short equity. It's been around for over 60 years, even more. Jesse Livermore used to do this. Pair trading involves going long and short simultaneously on a trade. And lots of hedge funds use it, institutions and other market participants. The main attractions of it are its controlled risk, low correlation to the market averages, and the ability to generate significant and consistent returns. So it's a great way to build a ticking over money machine that it's not going to blow the lights out in 1 month, but it tends to deliver, and we'll see the returns, but just consistent, profitable returns. So a lot of people think that the best way to make money in the equity markets is just to go long with the right stocks. Well, that's not the safest, and it's not the best way to make money in the markets. It has been a very good strategy for the last 9 years in the longest one of the longest bull markets in history, but the market character is changing. And we'll show you that the secret to start making more winning trades is with hedged equity positions. So the pair trading method, so contrary to popular belief, a form of logic does run through the world stock markets. Stocks tend to be priced efficiently. Every now and then, though, something happens, and we got to remember that stocks don't buy and sell themselves. The orders for them are entered by people or high-frequency algorithms. People are driven by emotions. Emotions cause irrational decisions, and this is multiplied when it comes to crowds of people. And there are algorithms that push it even further if they see that there's a momentum building in one direction. So how does this apply to stocks and pair trading? Well, stocks should trade like schools of fish. So everything goes roughly in the same direction. About 70% of any share's movement is generally correlated to the overall direction of the market. So within a school of fish, let's say, all those fish within that school should swim in the same direction as well. If you take U.S. consumer goods shares, all other things being equal, i.e. no news out there affecting a particular stock, they should all trade in a similar manner because the macroeconomic factors affecting them are very similar. However, every now and then, one of them kind of turns and goes another way, up or down or whatever, and there's not necessarily a good reason why. So if for no good or explainable reason, such as news, two shares of this group, let's say Coca-Cola and Pepsi, diverge away from each other, as they have here, I mean, they're both going up, but Coke is going up way more, there's inefficiency created and an opportunity to profit. Because if historically you've seen that these should be very correlated and co-integrated, you know this is going to return. This is the relative share price performance in this graph of Coke and Pepsi. So what do you do to do a pair trade? Well, very simple. The stronger one you short and the weaker one you buy. And you wait for the relative performance to converge. And that's what we were talking about at the beginning of this presentation. And that's what's delivered that kind of 36% alphas per year. Then you exit when these two come together. And that is measured by our software, PTF PRO. It will tell you when is a good time to get in, i.e. when is this historically at a long standard deviation away from the ratio between the stocks, and when is it converged to a point where you want to think about exiting. Okay, there's a quote here from Buffett: the stock market is a device for transferring money from the impatient to the patient. Well, that's what this is. You see something that doesn't make sense, you put on a trade long short, and you wait. So what is the main benefit of this type of trading? You'll see here, this is a pair trade that's in an IB account for MASBECN. and it was put on at $2,500 a leg, $2,500 a leg. You can see the principal amounts when it went in. Now look at the market values. So what's happened here? The market this share, MAS, has gone up 11%, but because we hold a corresponding dollar value amount short of a highly correlated share, BECN, that's gone down 9.9%. So even though if you had just done the short leg on BECN, you'd be losing 245, you've also got the long leg, which is making 276, and you're playing for this little bit of profit here between 276 and 245, which is the convergence of these two shares back to their historic ratio, okay, mean of the historic ratio. And the up and down movements of the market, in this case over 10%, haven't really affected your account. So that's why we say it's hedged. It doesn't always work perfectly, but it's a very, if they're highly correlated and co-integrated, it's a very strong hedge. And why does pair trading itself work better than stock picking? It's very hard to know what's going to happen to the price of any security or even an index. Here's SPY versus DIA. Now let's say you go here. Do you know whether this is going to go up or down or sideways? No, you don't. But because historically SPY and DIA are highly co-integrated and correlated, what you have a pretty strong conviction of being able to say is if this goes up, this one will also go up, or if this goes down, this one will also go down. And if they get too far apart, they're going to come back together. And that's precisely what we're dealing with here. So we don't need to know whether the market's going up or down. We just need to know whether two highly correlated stocks are at historically far apart for no good reason and that they're going to come back together. So that's one of the great things about pair trading. It works in all market conditions. So how do you find those high probability pairs to know which ones to trade? Through rigorous statistical backtesting, fundamental analysis, and news analysis, which our software is specifically designed to help you do very quickly and easily. And it works best on large mega cap stocks with high liquidity. Why? Because you need a short leg, so you got to be able to borrow. And every time you trade, you're in and out on 2 shares each time, so that's double the commissions. And you need margin and you need stock borrow fees. So you want to keep your trading costs as low as possible. Very quickly, I'm going to breeze through the history. Started by a guy generally credited to a guy named Alfred Winslow Jones, an Australian. He started a hedge fund, the very first one, supposedly, called A.W. Jones & Co. And essentially what he did was he used leverage to buy as many shares as his broker would allow. Then he sold short an equivalent amount to avoid the market risk on that long position. And he bought as many as he sold so that there would be a wash, what we were just talking about before. The crucial question then became, did he go long the right ones and short the right ones so that he makes a lot of money as the market moves? Do they reconverge? How did he do? From 60 to 65, he returned more than 325% despite a 20% management incentive fee. Over 10 years, so here's that 5-year period, and he beat all the long-only funds that were there at the time and the index very nicely and with lower volatility, as you can see. He did 670% or 6.7 times his capital in 10 years, and that's after a 20% management fee. He did so well that Carol Loomis of Fortune was profiling him in 1966 and called him a hedge fund. And that article and his success led to over 130 hedge funds being set up over the next 3 years, including Soros's Quantum Fund and Steinhardt Partners. Where does it really come into its own? Well, Morgan Stanley, back in the mid-1980s, put together a group with 3 guys running it, Jerry Bamberger, David Shaw, and quant trader Nunzio Tartaglia. And they worked part of an ultra-secretive group that was in search of the holy grail of trading. What were they doing? They studied arbitrage opportunities in the equities markets. And they employed advanced statistical modeling, like we've been talking about, and they developed an automated trading program to exploit the market imbalances. Okay? Essentially everything we're talking about here today. In 1987, they made $50 million from Morgan Stanley. That's the only time they broke out the profits of that group specifically, so we don't have other information. But what's going on today? Well, many large hedge funds from around the world continue to use pair trading as a means to deliver low-risk, high-reward returns to their investors. The largest hedge fund in the world uses pair trading. Jim Simons of Renaissance Technologies testified to Congress in November 2008 that his fund primarily paid pair trade stocks. Okay, well, big deal. Well, he just so happens to have the largest hedge fund in the world. He has achieved 2,738% return for his investor on billions of dollars of equity over 10 years and was ranked as the 55th richest person in the world by Forbes. That represents more than 27 times his capital in 10 years. And this is a guy who started out as a mathematician. Okay, so pretty nice use of mathematics. How's it doing today? Here's a very recent article from May 30th. Quick review of the top earning hedge funds in the world shows that pair trading remains well on track. According to the FT, James Simons of Renaissance Technologies topped the pay list for the third straight year, earning 1.7 billion personally, up from 1.6 billion personally the previous year. We also note the inclusion of 3 founders of 2 other pair trading funds in the top 10 earners, David Shaw of D.E. Shaw and John Overdeck and David Siegel of 2 Sigma. Both D.E. Shaw and 2 Sigma trace their heritage back to that Morgan Stanley's ultra-secretive Holy Grail group back in the 80s. We talked about David Shaw as part of it, and John Overdeck and David Siegel at 2 Sigma worked for D.E. Shaw. So do we have your attention yet? These guys are making consistently a lot of money through pair trading. So why isn't everybody doing it? There's a great quote here. It is rarely in the best interest of investment bankers and mutual fund managers to share profitable trading strategies with the public. So the pairs trade remained a secret of the pros and a few deft individuals until the advent of the internet. Very quickly, you couldn't do this 20 years ago, but now you can. You've got the internet, you've got cheap real-time market data, you've got very low cost commissions, you've got CFDs that you can trade if you're non-US, non-Canada. So you have very cheap leverage, and you can do everything that the hedge funds used to be able to do, and you can do it from your laptop if you want. So the one thing you have that they don't have is you're small, and you can play in smaller cap shares than they can, and that's a big advantage. So how long does it take, and when do I have to trade? Equity pairs trades last about 10 to 40 days each, with the average being about 25 to 30 days. You usually, if you're running a small account fairly concentrated, you run maybe 10 to 15 pairs at any given time. And that's 20 or 30 positions because you're long short on each. Though if you go larger account size, you're obviously going to have a smaller position size, and you might have 150 pairs, okay? But on account that size, it's generally about 10 to 20 end of day pair trades per month, 1 or 2 trades per day or so. And you usually enter those trades at the last hour before the close or about 30 minutes after the market open, wherever you're trading, whichever market. So the total ongoing time commitment is about 20 hours per month after you learn your craft. And you must check market movements once per trading day, although Pair Trade Finder will send you email alerts, about 250 days a year. What can you expect to earn? You guys can go through this stuff more in detail on your own. I recommend you go to our blog.pairtradefinder.com. Check out the pair trading resources. It's got all of these studies there, and they're very interesting reading. But we go back to this study of Jason and Jenny Chen, 36% annually for an equally weighted portfolio, so self-financed portfolio. And a very interesting one from Deutsche Bank, which is even more recent, 2016, where they did an examination of an enhanced pair trading strategy for over 40 years. They documented economically and statistically significant profits of around 1% per month unlevered. So is it still profitable? Well, we pull up a chart from that Deutsche Bank report, which I think is very interesting. And it shows all the way up to 2016, the average monthly pairs return on their enhanced pair trading strategy. And they correlated, or they lay over at the VIX, okay? And what it shows is that pair trading tends to be more profitable in volatile markets, which we think we're heading into now. Certainly 2018 is much more volatile than 2017. And what you see is that when volatility kicks in, pair trading profitability also increases. But also notice here, there's only 4 months in a 13-year period that were negative. There are a few like 0 months, but on average, you're doing about 1%. And this is unlevered. So it's a very consistently profitable strategy. So let's say, again, we go back to the Chen study. I just pulled out another quote here. The reason the way they've set it up is they've chosen 50 stocks, diversified, and they've got tradable portfolio opportunities every month. The capital can be fully invested all the time, and their approach produces equal weighted returns of 1.7% per month, okay, over the period. So that's unlevered. You know, you can probably lever that double what they've done or even triple. But let's say you're earning 1 to 3% a month and you've got a 100 grand account. If you're trading for income, that means you could take out 1 to 3,000 a year. That's purely illustrative, okay? But what's the really big deal about, say, 2 or 3% a month? Well, it's about compounding. Here's an illustration of if you have a 50 grand starting balance in your account and you decide, I'm going to pair trade for the next 10 years on that account. And let's say you do pretty well, 2% a month consistently. It means that by the end of year 10, you'll have $538,258 on an illustrative basis. That's just compounding that by 2% a month. That's 9.8 times your capital at 27% IRR. Well, this is where you're seeing these types of multiples that Jim Simons and others have been getting using stock pair trading, because they've been doing it forever and ever, and their compounding is incredible. So yeah, they're getting 20, 30 times their capital over a 10-year period. So if you want to do this, here's how we suggest you do it. We have Pair Trade Finder Pro. As we said, it's the industry-leading pair trading software for online traders. Most importantly, it's easy to learn and use. We've sold over 2,000 licenses. Over 6,000 people have tried it out. It's been 10 years in the making, and it's truly global. You can trade over 1 million different instruments from 126 exchanges in about 20 countries, I think. So stocks, ETFs, futures, Forex. Now, what is it exactly? It's nice to show a picture, but first off, what it does is it's a very powerful back tester. So you can take a whole bunch of tickers that should be fundamentally correlated and back test all of your parameters that you would want to use on your pair trading strategy and see the results of every stock versus every other stock. And then you can go through and select the best performing ones and see the equity curve, see the ratio, how it's been performing over time. Once you find the stocks you like, you save them to your watch list called My Watch List. And then Pro is a market radar that never sleeps. So every one of those pairs you've saved and every one of the parameters around how they are moving together, Pro is acting as a radar and will tell you exactly when they get to the point where you want to enter or when they get to the point where you want to exit. And it does that real time if you have real-time data. And also, every time you save a pair, you can then look at it in detail all the way up to over the last 10 years to see from your backtest every entry and every exit, how they did, how it related to correlation, to volatility, to the spread, to whatever you want to look at it against, and you can see it visually. You can also do that for out-of-sample backtesting. If you've got pairs on your watch list you've been watching for 6 months, you can see how they actually would have traded. Importantly, one of the things we think makes this so powerful is we integrate with interactive brokers. So if you have an IB account, then you get real-time and historic data at no extra cost above what you pay to IB for those feeds. FX data is free of charge, and you can cover over 120 markets in 26 countries, which is pretty powerful. If you don't have an IB account, you can get your data into Pro through IQ Feed, which is a subscription. It's about $84 a month. And they cover FX, they cover NYSE, NASDAQ, Amex, Toronto Stock Exchange, and London Stock Exchange. And really importantly, in the latest version of Pro, we've been able to reinstate the delayed data feed that Yahoo can provide. So Pro comes with the Yahoo Finance feed automatically enabled. And so you can do all your back testing and you can create your watch list and you can generate trade signals just using Yahoo Finance stock data. And that covers a fair number of world equity markets. So then what does it do? So you've connected to your data sources, run all your back tests, saved it to your watch list, and the market radar is in place. Well, it then sends you alerts via email or on screen and audio, highlighting when and at what price to enter a trade with automatic position sizing, which you set based on how big a leg you want. And you customize it. So this is what an alert looks like here. For example, an exit alert. So this is in November 2017. Exit trade PLCE ROST. Sell to close 98 shares at 118 a share. This is what your cost base is. Buy to close 160 ROST at this price. And then it says gross profit of trade $1,270 and tells you what group it was from. Okay. So the other great thing we've added into the latest version of Pair Trade Finder Pro, version 1.3.3, is you can automatically send your trade alerts to your Interactive Brokers Trader workstation for execution. And importantly, we've included a pair trade order type, which means that it's a limit on the short leg, and as soon as the short leg's filled, the long leg gets filled at market. So it's one-click execution. And we've also allowed you to skip the confirmation step in ParaTrade Finder Pro so that you can literally just open up your trader workstation each morning and you'll have all of the signals as pair trade orders sitting in your TWS for you to just click, click, click if you want. All right, so that's as close as possible to fully automated trading without being automated. You still need to confirm in TWS. Why IB? Well, we think it's a no-brainer. Their commissions are 87% lower than their competitors, and they win all the awards as the best online broker. We have high trading costs. With pair trading, you've got to have a very low-cost broker. Testimonials, you guys can go through these, but I take one from Rick here. I use the original pair trade finder every day. I use it in combination with fundamental and technical tools to identify pairs. I've been using the system now for 5 years, and I'm running close to 10 million of capitals in pairs. Well, he's not going to be doing that if he isn't, profitable over that 5-year period. So what do we have for you? We've got a special offer for you, and we said at the beginning of this presentation that we're convinced we'll be in a position to get you from where you are as a trader or investor now to generating consistent trading profits in less than 30 days. And here's how we think we can do it. We're going to turbo boost your startup as a pair trader. And how's that? Well, we've done all the hard work for you. We spent over several weeks and looked at over 1,800 large cap securities and found the top 30 pairs that backtested and correlated best. Okay, here's an example of them. Each pair had to meet very stringent backtesting and return hurdles over the past 3 years and pass a fundamental screening. And we now offer these hand-selected top 30 US equity pairs auto-loaded for free in ParaTrade Finder Pro to a new subscriber in this offer. Okay, so if you subscribe to ParaTrade Finder Pro through the STOCKTRADERS.net special offer, you will auto-load these top 30 pairs, and they can help you generate high probability signals right out of the box. And we trade them ourselves, and even the raw unfiltered results from these signals over the past 5-6 months has met our expectations. It's generated $17,715 of profit. I don't have all the stats here, but suffice it to say that it's making money just on the raw signals, and we need to filter trades to only pick the best ones. So now let's take a look at what ParaTrade Finder Pro plus those top 30 pairs might be worth to you. Okay, let's say you're trading a 50 grand account, and I don't know, you're not doing great, you're not doing terribly, but you're making 5% a year. Well, you're making 2,500 a year. Is it really worth the effort? Now, what if you can get something like this and you can net 30% a year, which as we've seen is, it looks like it should be possible based on the research. Okay, that would be a 6 times difference, or 15,000 a year in total profit on a 50 grand account. What would you pay for a 15 grand increase in profits? Would you pay up 1,500? Would you pay 20% of it, 3,000? Let's say you put it in a hedge fund and they got you that 30%. Well, they would charge you a 2% fixed fee on your 50 grand. That's 1,000 a year, and 20% of the profits, which in this case would be 3,000 a year. They would charge you $4,000 for that return profile, okay, for that 30% return. They also generally have 100,000 minimum investment, and you need to be a high net worth investor. Well, ParaTrade Finder Pro helps you do it yourself, and you find the right pairs to trade and tells you when to enter and when to exit, and you can do that on less than an hour a day. So you do it yourself. This information is significant value to any trader, and it's what we want. We know because we've been using it, and it works. So while we believe we could easily charge $1,500 a year for Pro, just the fact that you can use IB data feeds now means you don't have to subscribe to IQ feed. That saves over $1,000 a year in IQ feed costs to get real-time data. We currently offer Pro to the public at $599 a year. That's 60% off that lower figure. Okay, this month that price is going up in the next few days to $659 a year, and that reflects the recent upgrades in 1.3.3, which you'll be getting in this offer, which we touched on briefly before. So, however, at Monaco Traders Request, we're going to offer you ParaTrade Finder Pro annual subscription, which is regularly $659 for just $399 a year. So that's 40% off the retail price, and that's only $33.25 a month, or just over $1 a day. Okay, that's 1/5 the cost of a Starbucks latte in Miami, USA. So if you're in the habit of buying a coffee every morning, this is 1/5 of the cost. And very importantly, if you look at the average return per trade on the top 30, it's around 600-700 per trade, and a lot of those are 80% chance of winners. Just one of those at 600 would more than cover the cost of Pro for the whole year. Okay, so what's more, If you subscribe now through the special offer for $399 a year, we're going to keep that subscription fee for life. So as long as you stay subscribed to PTF Finder Pro for life, that price is going to be what you pay, $399 a year. And we're going to be improving the product, and every upgrade is free to subscribers. And as we improve the product and expand its power and reach, it's going to get more and more expensive. So it's a good thing to be able to do, is to lock in that price. And as our special bonus we talked about, we've preloaded this with the top 30 US equities pairs, which we believe will turbo boost your pair trading results out of the box, and they're yours for free, and that's a $250 value. Now there's more. Every new subscriber to Pro gets to watch our 3-hour 11-lecture video training course. That's included for free, and you learn from a pro pairs trader how to risk manage, how to find the best securities pairs, and how to trade them so you maximize your opportunity to be consistently profitable. We'll also give you how-to tutorials on all of the aspects of Pro, so you can just watch and figure out how it all works. And we'll give you a copy of our ebook, which has got some of the top tips from pro pair traders about how to find the most profitable trades, how to screen. Okay. You can also go to our blog. We have a trade of the month every month, which is a detailed trade analysis that takes you through our thinking and how we choose trades. And once you set yourself up with Pro, with the top 30s loaded in, we think, and you go through all our tutorials and you do the training course, we think you shouldn't need to spend more than 30 to 60 minutes a day on trading. So here's what you do if you want to get started. Just click the subscribe now, the link that Louis got there, and that will take you through to the payment page for this special offer. And again, just to recap, the special offer is on the latest version of Pro, version 1.3.3, $399 a year, 40% off, a savings of $260 a year. Our special bonus, the top 30 US equity pairs for free, it's a $249 value, and free our 3-hour pair trading video course from a pro pair trader. So don't wait, order now.